Chris, thank you very much. You've done a great job. And, we had a little bit of confusion because Scott Leonard had not replied to answer mine, but Scott's on to speak about a SPAC. And SPACs are incredibly hot right now. I think there's a hedge fund manager in New York, David Ackman, who just raised $4.5 billion for a SPAC. And for people who don't own a SPAC, is a special purpose acquisition vehicle. And actually, I'm going to let Scott take it away. So Scott, why don't you introduce yourself, pull up your slideshow, and talk to us about what you're doing. You've got 15 minutes.
Great. I didn't want to interrupt, so I've been on waiting, but
No worries, Scott. Let's go. We're tight. Thanks.
So I'm Scott Leonard. I'm the CEO of Sustainable Opportunities Acquisition Corporation. We're a $300 million SPAC. We are dedicated to making ESG-oriented investments. As a quick primer, if you think about SPACs, we're a hybrid form of private equity. So to the extent that you think about us in terms of private equity, we are making investments that are directed into a company that's private. We're getting some feedback, so I don't know if everybody's clear.
It's the biggest SPAC in Texas, so.
Great. So do we have a slideshow?
We do. So, but let me round out before we get into the slides, because people get too much time to look at slides. But I'll say that, when you think about SPACs, we're looking for very good private companies that need additional capital to either enable growth, to get a different ownership, some liquidity, or to delever the balance sheet. And we've seen that happen in great numbers in the past year. We think acquisition corporations or SPACs have really taken off in the terms of the amount of dollar volume. We've seen $19 billion raised in SPAC capital this year on the public market exchanges, compared to 13 for all of 2019, which is a banner year as well. We're seeing.
Scott, is that global? 19 billion?
That's a U.S. number only. So this
because I have a hedge fund guy who raised $1 billion in 2 SPACs for cannabis last year.
Yep.
In Canada. That's in Canada. So keep on going. Sorry.
Yeah, no, there's and all SPACs are, I shouldn't say all, most SPACs are thematic. Some go after consumer products, some go after energy investments, some go after cannabis, as you said. We chose a thematic that was specifically oriented towards ESG or sustainable investing. So we've got a fund that can look at pretty much any type of investment, but it has to fit an ESG or an environmental, social, and governance screening criteria. We're the first ESG SPACs. We think there'll be others that copy us. As I said, we've raised up $300 million. Our plan is to put that to work in one fell swoop. We plan to bring, anywhere between 100 to $400 or $500 million of additional co-invest money in the form of a PIPE alongside with us. So we expect to write a check that'll be north of $500 million for one company. And at the end of the transaction, what we call de-SPAC, we'll end up with a company that's got the right capital structure. That's from our case, that's somebody that's partnered with a group of seasoned operators and investors, and that company will also have a public listing. So there's a lot of times when people think of SPACs as a reverse way to enter the public markets. As I said, we think of it as a hybrid. I'm going to share my screen right now to just walk through kind of our overall thesis.
And Scott, before we go any further, where are you physically located?
Yeah, we've got offices in Dallas, Houston, New York, and Minneapolis.
And you are in Dallas right now?
I'm in Dallas.
Perfect. Okay, great. That's all I wanted to do. Okay, slideshow?
Yep. Let's see.
Just do a share screen?
Oops.
Awesome, great.
There you go. So, as I said before, let me go up. We are Sustainable Opportunities Acquisition Corp, and this is the deck that we use to talk to folks who are getting an understanding about what we intend to do. So, our starting point is that we tend to see greater value in investments that we make than others do, in large part because we are a set of transformative operators. We've got over 100 plus years of operating. We've got over 50 plus years of investing when you look across our team. We firmly believe that when you look at the type of transformations that we've led in the past, when you look at the type of transformations that we've looked to enable with our capital, we'll not only have the ability to unlock significant earnings power inside of the company that we partner with, but we'll also have the chance to make that company eligible to other ESG investors. And we think by increasing the ESG focus of the company, that'll increase the amount of potential investors that might put a higher premium on it than if it was just being valued as a cash flow oriented company. And you might ask, well, why is that? And the rough answer is that ESG capital is growing at a tremendous pace, over 20% per annum in terms of capital that investors are dedicating towards an ESG thematic. Just to give it by the numbers, in 2018, we had over $30 trillion dedicated to ESG capital. We think that number will double by 2022. And we think that by 2025, there'll be over $120 trillion of ESG capital looking to make both debt and equity investments. We've seen, as you can see in the top right, the amount of press that folks like BlackRock's Fink and State Street's Terpeleva have given in very large ways to the importance of ESG for their own funds is it's color commentary on top of the numbers. But we know that there's going to be a lot of ESG capital, and we know that ESG oriented companies outperform those that are laggards by as much as 40%. Companies that have an ESG focus tend to be higher quality stocks. That's an academic definition that we use. They tend to see much less frequent chances of large price declines, and they tend to see much lower odds of becoming insolvent, and they produce higher returns when you put it on a 1, 2, 3, 5-year basis. So we know that ESG is not only drawing in a tremendous amount of capital, but that the spread between folks that have an ESG story and a strategy that involves ESG and those that don't is a gap as well. And I show up page 5 of this presentation. We think that when it comes to measuring environmental, social, and governance standards, when viewed through the lens of an investor, progress matters more than perfection. Quite simply, it used to be the case that when you thought of an ESG or sustainable investment, you would think of only pure green companies that were disruptors requiring large amounts of capital with business models that may or may not succeed. But we pulled out a number of examples. We highlighted 4 household names: Johnson Controls, BASF, Caterpillar, Honda. These are all companies that qualify for the MSCI ESG index, which is kind of one of the gold standards in terms of evaluating who makes it and who's deemed an ESG oriented company. We know that both disruptors that are truly green companies as well as typical businesses that have adopted an ESG strategy can make their way into that index and access that $120 trillion of capital. And we also know that the progress that companies that are more traditional make pays. Page 6 outlines over $4 billion of recurring profits that have been generated by big household names: Walmart, United Airlines, Unilever. These are all companies that have reported publicly where they got bang for the buck for the ESG programs that they put inside of their company. So we know that not only is there a large amount of ESG capital, we know that ESG outperforms, we know that traditional companies can be deemed to be ESG friendly, and we know that when you run the programs right, they add to the bottom line. And the last thing I would say is that we think every company in America is going to have to undertake a transformation to be more sustainable and ESG oriented. And we believe that for the companies that step forward and do something different today, particularly to impact climate change, to embrace the social changes that are going on, to embrace good governance, diversity, inclusion, as well as transparency, that this is a great time to look at a company and have an inflection point. What we did was we went back to the financial crisis 10 years ago, and we looked at who won and who didn't. And the people that won were the ones that took action. Winners in the last Great Recession, they locked in their structural cost gains, they revamped their strategy, they bought some companies that tucked in well, and they cleaned up their balance sheet. We know that the folks that won coming out of the last Great Recession were folks that capitalized on a period of disruption. While what we're experiencing right now is a real human tragedy first and foremost, we also know that it does provide time for a company to really have an inflection point. And so we think that the time to take our capital as an investment in a company could not be better. A little overview on us. We're 8 dedicated professionals. We think we are the largest, or if not the largest, one of the largest teams focused specifically on deploying SPAC capital. We see a lot of folks in the SPAC game that are part of a larger private equity organization or have a few very senior executives and deal professionals. We know those are great guys out there, but we think our teams, we think we've got a special recipe. We've added a lot of talent. This group has all worked together off and on for the past 25 years. The nucleus of the group started at McKinsey back in 2000. Both our CFO, our head of operations, and Patrick Williams, who's an advisor, will be joining us shortly. That whole group, we all started at McKinsey. Gina and I worked together when we were part of John Wilder's team to help reform and eventually lead the privatization of TXU. And then Scott Honor, who's our chairman and my partner, ran the Gores Group for 10 years. We overlapped when he was at DLJ. He was there for 10 years and was part of the leadership team of the LA office with Ken Mullis. So we've got a great group. We've got the ability to metabolize a lot of information quickly and make decisions very quickly when it comes to looking at opportunities. We're seeing a lot of them right now. And we're rounded out by a great board. We've got a very large public equity investor, Justin Kelly, who's the CEO of Winslow Capital. It's a $20 billion long-only fund that's sustainability focused, backed by Nuveen. Rick Ginzel was employee number 35 at Soros. He started their private equity efforts. And Rick rounds out the private equity thinking at the board level. And then Isaac Barkus is an early stage investor who's partnered up with Reid Hoffman, the founder of LinkedIn, to form Research Bridge Partners. So we've got a great board that we tend to think of them as a triangle. We've got an early venture investor, a late stage private equity investor, and a public markets investor. And on top of that, we think we have great professional partners as well. Kirkland has been our legal counsel on a number of endeavors prior to this and was issuers counsel for us. Citi, we think, is the leading ESG-oriented bank in the U.S. We chose them because they understood our thematic better than anybody else, and Citi was the one that led our $300 million underwriting. And when you think about our team,
we have about 5 minutes.
When you think about our team, you think about a few things. One is, do we have deal experience? Do we have operating experience? And do we have ESG experience? And we think we have it in spades. We've led over 100 platform and add-on acquisitions. We've been involved in over $60 billion of transactions. We raised over $40 billion of capital across our respective careers. From an operating standpoint, we have 100 plus years of experience in senior commercial roles and operational and management roles. I've been a CEO, a CFO, a COO. That's a similar profile to a lot of the operating partners that we have on board. And our efforts over the past 15 years, we've generated over $20 billion of shareholder value. And we've done this across a range of industries, including the transportation space and the energy space and the technology space. We've seen a lot. And when it comes to ESG, if you look back at the work that we've done, every transformation we've been a part of has had a substantial ESG impact that was realized. In our last transformation, we offset 2+ million tons of annual CO2, which we were quite proud of. And you can look at some of the investments that Scott's made most recently that have an ESG-oriented impact as well. So we think we've got the right team to go execute the ESG thematic. The last thing I'd leave you with is that we do tend to think that operator-led SPACs have an inherent advantage. When you look at how operator-led SPACs perform versus the sector index and other IPOs, looking out a year from the time of IPO and along the same time period with the sector index, we see a real pop that comes from having operator investors, sustainable investors, transformative operators partner with companies. We think that SPACs as a whole are faster than IPOs. They have the potential to generate better returns, both gross and net. And we see that coming to fruition of the fact that there's just a lot more capital being raised. So is
this chart all time, or is this for the last 5 years or so?
This is from 2016 to present.
Okay, so it is from the last 5 years. Okay.
Yep, the sector is versus the S&P, and we filtered for SPACs that were at least of a certain critical threshold size. So there's 42 transactions in here, and we think it's a pretty good data set. So
sure. One of the nuances of SPACs is that SPACs go through 2 periods of approval from the investors, right? There's the initial investment period, and then once a target is selected, there's the approval, correct?
yeah, exactly. You got it right. You know, we raise the capital with our thematic and our track record, and when we deploy the capital, we go back to our investor base and ask them to approve where we're going to place that capital.
And do you guys have a target yet? You've raised the capital already. Do you have a target for this?
Yeah, we've, you know, without tripping into MNPI, we've got a lot of things going on, and we're excited about things we'll be talking about in short order.
Okay. We've got a couple more minutes.
And I don't know if there are any questions, if you've opened it up to questions in the past, but I'm happy to take questions, or I'm happy to close it out. Tell me what that's for you.
So you're doing anything in renewables, large scale renewables? We have a question here.
Hello, Scott. Victor Sowers from TQ Energy Capital. You guys do anything in large scale renewables?
So we've looked at renewables. I think you see. Let me give you an overarching comment, and then I'll answer your question more directly. So, one of the things that SPACs must consider when they partner up and deploy their capital is what's the growth profile for a company. And so, when we need companies that have a high growth rate on top of having a good underlying business. And for us, when you think about renewables that are already in a producing state, those investments tend to have more of a yield-oriented feature, which doesn't get a lot of growth, and we think that SPACs aren't really advantaged in buying existing renewables portfolios. That being said, we do know that there's the opportunity for SPACs to partner with developers to fund the development capital, and we certainly looked at that and are happy to continue to look at it.
This is D. Smith. I have a Strategic Insight Group. I have a question.
Hey,
How
Dave.
do you go? Really good presentation. How do you go about verifying that companies that make ESG claims are actually fulfilling their ESG obligations?
That's a great question. So, as a SPAC, just like with any other type of private investment that you make, there's a long diligence list, and we've got our own short list of what it takes to be ESG qualified. But we also know that there are companies that aren't fully there yet. And we know that one of the things that matters a lot to ESG investors is not just how the company is performing today, but what's the path and the plan to continue to improve over time. That includes not only what are you doing in terms of your carbon footprint and your impact with the broader environment, whether it's water or air or other metrics. Velocity matters a lot. The other is that we've got advisors that are deep experts with very well-known firms that run sustainability practices that have the ability to see this during the diligence process and not only map out how the company is doing today, but what the plan should be going forward.
Any other questions? Well, thank you so much, Scott. I think it's really informative, and it's really fantastic. I mean, I'm stunned because we've been through so many cycles of SPACs where it was really up and then it was really down, and now we're going through this wave of SPACs that are huge. And I was surprised when I saw that there was a cannabis SPAC, 2 SPACs last year of more than 400 million each. And I'm glad there's an ESG. That makes perfect sense, SPAC out there. So maybe we'll hear more about more SPACs that you guys are doing. So, so thank you so much. And we're going to forward your contact information to all the people, et cetera. So they'll be able to reach out to you.